Ever wondered if accountants are secretly wizards? Because let's be honest, who else could make sense of accruals and cash accounting? To the untrained eye, these might as well be incantations from the Hogwarts school of witchcraft and wizardry. Right, let's dive into it. Accrual accounting, that's a bit like a time-turner spell. It records revenues and expenses when they are earned or incurred, not when the cash changes hands. It's all about timing, my friends. On the other hand, we have cash accounting, the Alohomora of the accounting world, unlocking the door only when the cash enters or leaves the vault. It's straightforward, no hocus pocus. Both these methods have their pros and cons, and their impact on financial reporting can be as dramatic as a duel between Harry Potter and Voldemort. So, brace yourself for a magical journey into the realms of accrual and cash accounting. Imagine being able to predict the future. That's a bit like accrual accounting, except with less crystal balls and more spreadsheets. Now, let's dive into the nitty-gritty of accrual accounting, the time traveler of the financial world. Think of accrual accounting as a time machine where you record revenues and expenses when they are earned, not when the cash actually changes hands. It's like seeing into the future, knowing that your business will receive money or owe expenses before it happens. This method provides a more accurate picture of your company's financial health, allowing you to prepare for the future. But like all time travel scenarios, there are potential pitfalls. This method can be complex and may result in recognizing revenue that may never be received. It's a bit like counting your chickens before they're hatched. So, accrual accounting is like having a time machine, but instead of fighting dinosaurs, you're predicting revenues and expenses. Exciting, isn't it? Ever wished you could only count your calories when you actually eat the cake? That's a bit like cash accounting. You see, cash accounting is like that cheat day on your diet where you only count the calories when you actually consume them. It's simple, straightforward, and oh so tempting. In the world of accounting, cash accounting records transactions only when money changes hands. It's like when you finally give in and buy that delicious slice of cake, only then does it count. No money, no transaction, no calories, right? But just like with your diet, there are consequences. While cash accounting is easier to understand and implement, it doesn't give a complete picture of a company's financial health. Imagine, if you will, having a fridge full of cake, but not accounting for it until you eat it. That's a lot of unaccounted cake, or in financial terms, a lot of unrecorded liabilities and revenues. So cash accounting is like a diet where you only count the cake when you eat it. Sounds like a sweet deal, doesn't it? So, what happens when our time-traveling hero and dieting guru face off in the accounting arena? Let's find out. Imagine our time-traveling hero, always leaping forward, representing accrual accounting. He's all about recognizing revenues and expenses when they're earned or incurred, regardless of when the cash is actually exchanged. It's like celebrating your birthday a week early because you know it's coming up. On the other side, we have our instant gratification guru, a staunch representative of cash accounting. He's all about the here and now, only recognizing revenues and expenses when the cash changes hands. It's a bit like refusing to celebrate your birthday until you've physically unwrapped all your presents. These two methods can paint very different pictures of a business's financial health. Accrual accounting might show a promising future, while cash accounting keeps us grounded in the present. And there you have it, the epic showdown between accrual and cash accounting. Who knew accounting could be so dramatic?